If your business made $10,000 this month, but your bank account still feels empty, you are not imagining it. Revenue can be real, profit can look healthy, and cash can still arrive weeks later. That gap is the cash conversion cycle, and for a young business, it can be the difference between calmly making payroll and putting a bill on a personal credit card. Welcome back to the Owner's Ledger. Today we are making the cash conversion cycle practical. No finance degree, no giant spreadsheet, and no pretending that a sales number is spendable money. By the end, you will know exactly where cash gets trapped, how to measure the delay, and what to change on Monday morning so the money you earned reaches your bank account sooner. Here is the promise. This episode will help you separate three numbers that owners constantly mix together. First, revenue, what you sold. Second, profit, what remains after the costs assigned to those sales. Third, cash, what has actually cleared into an account you can use. Those numbers can point in three different directions at the same time. Imagine a small design studio. In May, it signs a $12,000 project. The client approves the invoice on May 31st, but the contract says payment is due in 45 days. The studio pays a subcontractor $3,000 this week, buys software, pays rent, and sends the owner a modest draw. On the income statement, May may look profitable. In the bank account, the $12,000 is not there. If the owner reads the bank balance as profit, panic follows. If the owner reads the invoice as cash, the next payroll creates a crisis. The stakes are higher when growth makes the problem worse. A product company may need to buy inventory before a customer order arrives. A contractor may buy materials today and collect after inspection. An agency may deliver work for 30 days before billing, then wait another 30 days for payment. More sales can mean more cash tied up before the sales turn into usable dollars. Chapter 1. The 4 stops in the cash journey. The simplest way to understand the cycle is to follow $1. Stop 1 is the sale. You deliver a service or ship a product and you create revenue. Stop 2 is collection. The customer pays and the money clears your account. Stop 3 is payment for what you needed to make the sale, such as inventory, contractor labor, materials, or fulfillment. Stop 4 is the release of that cash back into your operating cycle, where it can fund the next sale. For a service business, the biggest delay is often between delivery and collection. You do the work in week 1, invoice in week 4, and receive payment in week 8. For a product business, the delay often starts before the sale. You pay a supplier in January, hold inventory in February, sell it in March, and collect from the customer in April. The cash went out long before it came back. Owners often use the word profit when they mean cash margin. Profit is an accounting result based on when revenue and expenses are recognized. Cash is a movement in the bank. A $5,000 invoice can increase reported revenue without adding $5,000 to checking. A supplier bill can reduce cash today even if the related sale will not happen until next month. Do this Monday. Open your accounting system or a blank sheet and make 4 columns: sale or delivery date, invoice date, due date, and actual payment date. Pull the last 10 paid invoices. Do not guess. Use bank deposits and payment processor records. For each invoice, count the calendar days from delivery or invoice to cleared cash. You're looking for the delay your business actually experiences, not the payment terms printed on your template.
If your average is 42 days, that is a financing requirement. Your business must survive 42 days between doing the work and receiving money. On $10,000 of monthly billings, even a simple approximation can show the pressure. 42 days is roughly 1.5 months of activity waiting in the pipeline. That does not mean you need $15,000 in reserve, because costs and timing vary. It does mean a zero buffer bank balance is not a strategy. Chapter 2. Measure the cycle with 3 numbers. The classic cash conversion cycle uses 3 pieces: days inventory outstanding, days sales outstanding, and days payables outstanding. You do not need to memorize the terminology, but you should understand the direction of each number. Days inventory outstanding asks how long cash sits in products before they sell. If you purchase $4,000 of inventory and the average unit sits 60 days, cash is parked on a shelf instead of working in your bank account. Days sales outstanding asks how long it takes to collect after a sale or invoice. If invoices average 35 days from billing to deposit, that is the collection delay. Days payables outstanding asks how long you take to pay suppliers and vendors after receiving the bill. If your negotiated terms are net 30, your cash may remain in the business longer than if you pay immediately. The basic relationship is this: cash conversion cycle equals inventory days plus collection days minus payable days. A company with 60 inventory days, 35 collection days, and 30 payable days has a 65-day cycle. That is not automatically bad. A healthy business can operate with a long cycle if its margins, financing, and reserves support it. The point is to know the number before growth exposes it. For a service business with little inventory, you can treat inventory days as close to zero and focus on collection time. Suppose you invoice $20,000 a month and collect in 45 days. A rough planning view says around 1.5 months of billings may be outstanding at any point, though the actual amount depends on the billing pattern. That outstanding balance is not a reason to celebrate or panic. It is a reason to set a collection policy and fund the waiting period. Now separate 3 buckets on your cash forecast. Bucket 1 is cleared cash, deposits that actually settled. Bucket 2 is committed cash, signed invoices with a clear due date. Bucket 3 is hopeful cash, proposals, verbal promises, and invoices with disputes or missing purchase orders. Only Bucket 1 should pay bills due this week. Bucket 2 can inform next month. Bucket 3 should not be used to justify spending. Due this Monday. Create a 14-day cash view. List the starting bank balance, deposits with a confirmed settlement date, bills due, payroll, taxes you have set aside, and owner transfers. Mark every line as cleared, committed, or hopeful. If the view goes negative, do not immediately reach for a personal card. First, identify whether the issue is late collection, a bill that can be rescheduled, a purchase that can wait, or pricing that never created enough margin. Chapter 3. Shorten the collection side without damaging trust. The fastest cash improvement for many small businesses is not a new loan. It is a cleaner path from completed work to paid invoice. Start before the sale. Put the payment terms in the proposal, not in a surprise email after delivery. Use plain language. A 30% deposit is due to reserve the start date. Progress billing occurs at the agreed milestone, and the final balance is due upon delivery or within a stated number of days. A deposit is not free money.
It is cash received before the full work is complete, and it creates an obligation to deliver. Track it separately, so you do not accidentally treat the whole deposit as spendable profit. But used correctly, a deposit can fund materials and reduce the amount you finance personally. Next, make the invoice easy to approve. Include the legal business name, customer name, invoice number, service dates, purchase order number if required, a one-line description of each deliverable, the total due, the due date, payment methods, and a contact for questions. A missing purchase order can turn a 7-day approval into a 30-day delay. A vague description can create a dispute even when the work was excellent. Bill at the moment your contract allows. If the agreement says milestone billing, send the invoice when the milestone is accepted, not at the end of the month, because that is your habit. Use automatic reminders. A friendly notice 5 days before the due date, a due date reminder, and a short follow-up after the due date. Keep the message factual. Ask whether the invoice is approved, whether any documentation is missing, and what date payment is scheduled. Assign ownership. In a solo business, that is you. Put a 15-minute collections block on the calendar every Tuesday and Friday. Review invoices due in the next 10 days, invoices overdue by 1 to 7 days, and invoices overdue by more than 7 days. A customer who is 1 day late is a different conversation from a customer who has ignored 3 messages. Escalate according to your contract, not your mood. You also need a dispute log. Write down the invoice, the disputed item, who owes the next action,
and the promised resolution date. If a customer says, "We never received the invoice," resend it and ask them to confirm receipt. If they say the scope is incomplete, compare the claim with the signed deliverable list. The goal is to turn vague friction into a dated next step. Do this Monday. Choose the 5 largest unpaid invoices. For each one, write one sentence answering what exactly is blocking payment. Then take the appropriate action. Send a missing document, request approval, schedule a call, or apply the contract's late payment process. Do not send a generic "just checking in" message when you can ask for a specific payment date. Chapter 4. Protect cash on the spending side. Shortening collection helps, but you can also stop cash from leaving too early. Start with purchasing. For inventory, measure sell-through by item instead of buying because a supplier offered a discount. A 20% discount is not a savings if the product sits for 6 months, becomes obsolete, or forces you to borrow at a high rate. Set a reorder point using actual weekly demand and supplier lead time. For contractors and vendors, ask whether timing can match your customer billing. If you receive a deposit and use a subcontractor, a milestone payment may be fairer than paying the full amount before the customer approves the work. Put the schedule in writing. You are not asking someone to carry unlimited risk. You are designing a cycle where both sides know when cash moves. Review subscriptions and annual renewals. A $1,200 annual software bill may be cheaper than monthly payments, but it still leaves your account today. Before paying annually, check usage, cancellation terms, and whether the discount is worth the cash tied up. For every recurring expense, ask what sale or operating task it supports and when the benefit appears. Keep tax money and payroll money out of your apparent operating cash. If a customer pays you $8,000 and $2,000 is reserved for sales tax or income tax, the usable portion is not $8,000.
Transfer reserves on a predictable schedule. A cash forecast that ignores taxes is not conservative. It is incomplete. Build a minimum cash floor. Start with the next 14 days of essential bills: payroll, rent, debt minimums, utilities, critical software, and committed tax payments. Add a buffer for the bills that arrive unevenly. The floor is not a number you spend down to zero. It is the line that tells you when to pause discretionary purchases, delay an owner transfer, or accelerate collections. Use a simple weekly dashboard with 5 numbers: cleared cash, invoices due within 14 days, overdue invoices, essential bills due within 14 days, and cash floor. Add one operational metric, such as average days to collect. The dashboard should fit on one screen. If it requires an hour to update, you will stop using it right when the business gets busy. Here is the Monday action plan. First, pull the last 10 paid invoices and calculate the real collection delay. Second, list every unpaid invoice and mark it cleared, committed, or hopeful. Third, contact the 5 largest blockers with a specific next step. Fourth, review the next 2 weeks of bills and move any avoidable purchase that would push you below the cash floor. Fifth, set a Friday 15-minute review so this does not become another abandoned spreadsheet. Let us recap. Revenue is what you sold. Profit is an accounting result. Cash is what cleared and is available under your policies. The cash conversion cycle is the time between paying for inputs and collecting from customers. You shorten it by invoicing promptly, setting clear deposits and milestones, removing approval friction, following up on dates, controlling inventory, negotiating payment timing, and keeping a real cash floor. The goal is not to make every customer pay instantly or to delay every vendor forever.
The goal is to make timing visible and intentional. A business that knows it has a 65-day cycle can price for it, reserve for it, and negotiate around it. A business that ignores the cycle can look successful on paper and still run out of money on Thursday. If this helped, subscribe to the Owner's Ledger and comment "Cycle." The next time you review your books, I want you to know not only how much you sold, but when that money becomes usable. Check the description for the 5-number Friday cash tracker and use it before making your next big purchase. Next week, we will tackle the owner decision that causes the most cash whiplash: how to fund growth without putting every business expense on your personal credit card. Until then, protect the cash you already earned and make every dollar's timing visible.